What's up? Welcome to the channel. Today we're going to be talking about Moody's downgrade of the US credit rating and what it means for your wallet and your future. I made a presentation to talk about Moody's downgrade of US credit ratings, and I hope that this is helpful for you. We're going to talk about basically what it means for you and your wallet and your future and the future of the United States. We're going to talk about the shift in US credit standings. We're going to talk about what a sovereign credit rating actually is, why Moody's downgraded the United States' credit, how the market reacted, and what this means for everyday Americans like you and me. Let's just jump in. We're going to talk about this historic shift. So there's basically three major credit agencies, S&P, Standard & Poor's, which you might already know because of the S&P 500, a company called Fitch, and then there's Moody's. And collectively, all three of these companies make up 95% of credit rating agencies. And basically what they do is they analyze macro financial and statistical data to determine what a country's or bonds or company's credit worthiness is. So a lot of companies have credit worthiness, and countries do too. But something very interesting happened on May 16th, 2025. Moody's downgraded the United States of America from AAA to AA1. So this wasn't like a massive downgrade. It's essentially a downgrade just one notch. So from their highest tier to their second highest tier. And this is like the last of the top three firms to have downgraded the United States. Both Standard & Poor's and Fitch downgraded the United States previously, and Moody's was kind of the last. The United States has been ranked a AAA rated country in terms of their ability to borrow and the value of their debt since 1917. And so this new downgrade puts us on the same kind of level playing field as other top tier countries such as Austria and Finland, but we are no longer at the top. This is a profound symbolic shift, and I actually think that it's really important for us as Americans to pay attention to this kind of stuff because it officially is a crystallization of all of the concerns of this agency, and being as though like they're the last, it's solidified that there are financial concerns with the trajectory of the United States with respect to our ability to borrow money. It signals systemic concern, and I'm going to go a little bit more into that in detail because this downgrade has trickle effects throughout the entire economy. Additionally, Moody's is saying that they're concerned about the financial path of the United States, and there's a lot of things that they need to work on to get back on track. So I'm going to briefly go into an explanation of a sovereign credit rating and what it actually is. So effectively, governments continuously borrow money, and this is an evaluation of a government's or country's credit worthiness. Okay, so effectively all it means is if the United States borrows $1, how likely is it that they're going to pay you back with the agreed upon terms that you set in the beginning? That's it. But it is a valuable benchmark to investors. Effectively, a higher rating signifies lower risk. Lower risk equals lower interest. So historically, this has been incredibly important to the United States because a U.S. Treasury note has historically been considered the risk-free rate. Like if you put your money in a U.S. Treasury, if you invest in the United States government and buy a government bond, you're effectively guaranteed to get your money back. So basically what lowering the U.S. creditworthiness is saying is that, well, this risk is no longer risk-free. It's still low risk, but it is a little bit riskier than it was presumed before. As I said before, this is a profound symbolic shift to be downgraded in rating, and it's going to have all of these effects that I'm going to go into a little bit more in detail. And it also influences market behavior. It impacts borrowing costs. It shapes investment demand. The credit worthiness of the United States government is a powerful signal of global capital. I just briefly put up here an explanation of the ratings for Moody's, S&P, and Fitch. As you can see, we were ranked as AAA before, and now we are AA. This is the second highest ranking. The United States is investment grade. It's not considered a high yield or junk. High yield means that it is a lot of associated risk with that bond. The United States is still considered to be high credit worthiness and very low credit risk. So let's talk about why Moody's downgraded the United States. There are three core reasons. There are more reasons that we'll jump into as well, but the biggest three core reasons are the persistent and rising federal debt and deficits. The United States debt is higher than countries of similar size, and this is very much a concern. And I think you're already well aware of the US national debt as being a concern for probably the last decade or so. I mean, I recall talking about it when I was in college, which was a long time ago. And additionally, there's just been like consistent failure on both sides of the aisle, both Democrat and Republican, to figure out a way to come to a resolution on how we're going to solve the debt crisis in the United States. And right now, the annual deficit is about $2 trillion, so it's like 6% of the GDP, and that number's only growing. The second main reason is there's like an increased burden of interest payments. So this is something actually that I thought was very interesting. Servicing the debt is becoming more expensive, and it's actually going to be something that is even more and more costly because of higher interest rates. So the more perceived risk, the higher the interest rate. And so by 2035, it's expected to be 30% of the federal revenue just in interest payments on this debt. In 2024, that number is 18%, but it's expected to be 30% by 2025, which I think is insanely scary, because imagine your own household budget where 30% of your income goes straight to debt. That's not a recipe for success. This is a finance channel. Everyone knows that. That math ain't mathin'. And again, to emphasize this, is the political polarization and gridlocks that we've had in government for the last couple of years. Outside of just talking about the debt, we had issues with selecting a Speaker of the House. We have these issues with government shutdowns all the time. We're having these issues where we can't reach agreement on the debt ceiling. All of these political issues are impacting how these rating agencies look at the United States for our creditworthiness. If there's no consistency in how we go about setting fiscal policy every 2 to 4 years as members in office change, well, then that's going to become a problem. People are purchasing 30-year Treasury loans. That's a long time to not have a consistent framework to follow to ensure that you're getting paid your money back. So the next reason is fiscal deterioration. So this is a very interesting one. Federal deficits are expected to get wider. So by 2035, they expect that it's going to be 9% of GDP versus 6.4% in 2024. What that means is the government spending is getting larger and larger and larger as a percentage of what they're taking in. So we're going to continuously need to borrow more and more money to cover those deficits. And the federal debt burden is already huge, but it's anticipated to climb. So as of 2024, the federal debt burden is 98% of GDP. That number is expected to jump up to 134% of GDP by 2035. This number is insane when you think about what that actually means. Effectively, it is the total amount of money owed divided by the total GDP of the United States. So for simplicity's sake, if you look at 2024, our GDP is about $27 trillion, and we owe about $27 trillion, which is we owe all of the money that we've made and created in this country an entire year. What? These numbers are insane, and actually this is reaching a point where it's like higher than what we owed during World War II, where at its peak, we were at 106% of GDP. Also, all of President Trump's tax cuts are expected to contribute $4 trillion additionally to the GDP. So we're not exactly being attentive and making good decisions that are lowering this number. And this is gonna be, this fiscal deterioration is very, very important to our success. And it's a negative feedback loop, right? Rising debt equals higher interest payment, which equals wider deficits. And this creates reduced budget flexibility and debt affordability, right? Like the more you owe, the less you can borrow. If you owe 30% of federal tax revenue in just servicing the debt, you can't borrow more money, right? If that number takes up to 30%, 40%, 50%, like how will we ever pay for goods and services that our tax dollars are supposed to go to? What happens if another pandemic occurs, right? How do we stimulate the economy? How do we do quantitative easing for the next '08 financial crisis? So these are issues that really concern these rating agencies, because what happens when the United States government doesn't have the flexibility to borrow money to get us out of a temporary bind? Right now, when the economy is strong, we should be paying off debt, but somehow we're giving more tax cuts and we're trying to stimulate the economy by bringing in less tax revenue and taking on more debt. Like, it's kind of doesn't make sense. So the news in the stock market hasn't really had a major impact. If you paid attention to the news on Monday when the market opened, there were stock market dips, but slight decreases, nothing material. You saw the 30-year Treasury yield go above 5%, just slightly. There's some slight depreciation of the United States dollar, but there's limited impact here. The other two credit agencies downgraded the United States many years ago, right? So a lot of the concerns are already baked into the price. And so investors have kind of been expecting this for some time. But there are also mitigating factors, right? The economy of the United States is nearly $28 trillion. We are the biggest, we are the strongest economy in the world. We are very resilient and we are very dynamic. We produce all sorts of things from oil to iPhones, right? So the United States economy is very dynamic and very resilient. Also, like, the United States dollar is the world's reserve currency. And so while the entire world holds onto US dollars, it's going to be beneficial to us as a country. And so these are some of the reasons why the market has kind of reacted the way that it has. But in the short term, not much is going to change, but potentially in the long term, there will be a lot of impacts to how the US borrows, higher interest rates, and that's ultimately going to impact you, the consumer. So with that being said, this is a perfect time to talk about what this means for everyday Americans. So higher government borrowing costs equals higher consumer business rates. Simple as that, okay? You could expect increases in mortgages, auto loans, credit cards, small business loans. These higher government costs get passed down to consumers. Furthermore, as the dollar weakens, this creates a lot of downstream impacts for you as a consumer. It makes imported goods more expensive to purchase. Business will ultimately raise their prices because they're going to pass these costs on to consumers. We're seeing that today with the Trump tax, the tariffs. But international travel will be more expensive. If the dollar weakens and you go to France, your croissant is going to be more pricey. And then there's just ultimately an erosion of purchasing power. As the dollar weakens, you will be able to purchase less. These are probably some medium to long-term effects. They're not going to happen overnight, but you will eventually see these impacts potentially. So there will also be impacts on jobs. Higher borrowing costs eventually equates to slower investment and slower hiring. It's just going to create a cascading effects, which is going to ultimately lead to economic slowdown. Fiscal uncertainty is bad for business. End of story. If you know a small business who's currently impacted by these tariffs, they have no idea what's going to happen in the next 3, 6, 9, 12 months. So they stop spending. And when they stop spending, the economy slows down and yada, 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 right? All of this news is just signaling to the market that there are concerns from all of the rating agencies. But the majority of the concern and the threat and the impact was already known to investors. It might just be news to you. But it is here to signal structural weakness in the fiscal ecosystem of the United States. But we should be fine because the US dollar is king. And we have a very, very strong economy. We create a lot of goods and services that are valued and used all over the world. But it is a warning to everyday Americans, and there's a warning to politicians that we need to take action. When you vote, you should be thinking about the US deficit in mind and how we plan on servicing that deficit as time goes on. There's urgent need for bipartisan action here. Whether you're a Republican or you're a Democrat, this is a problem that is going to impact everyone. And so we need to be attentive to that now so we are not living with the consequences of this in the future. If we leave this unaddressed, obviously there's going to be long-term financial risk and financial impact to everyone, yourself and me included.